The stock market, or share market, has been available for investors for many years. This is the marketplace where you can purchase your stocks or shares of businesses, enterprises, and companies. Stocks of a company, government bonds, preferred shares, and other tradable assets are referred to as securities. By purchasing these securities, it can garner you money. However, with the ability to purchase stocks or shares of a company from the stock market in hopes of making more money, there's also the equal chance of losing a ton of money. Here are 5 things that you need to know before investing in stocks and the general stock market. Number 1. Investing in stocks is only one of many other options for investing your hard-earned money. When you decide to invest your money in the stock market, you should also remember that the stock market is not your only means of investing money. When you think about making money by owning assets, the most prominent thing that may come to your mind is housing or land. Houses are almost always appreciating in value and are always labeled as assets because it is something that you own. Of course, with that being said, buying property is definitely a way you can invest your money, but you must remember that buying property and other non-stock related investments is an entirely different game. The simplest example is the fact that investing in houses or properties will cost you hundreds of thousands of dollars, and you will have to pay up mortgages and loans in the long term. Aside from that, with the additional rise of cryptocurrency and NFTs, the stock market is no longer as prevalent in investing 50 years ago. If you don't want to invest in something and you trust your own skills, you can always invest in a business that you create. Number 2. You must learn about different accounts that you can have. Every country is different with this aspect, but in the United States, there are a few distinct accounts that you can create that each have their own pros and cons. The Roth IRA is a retirement account that you can create for free. It is tax-free when you withdraw your money during retirement and is also tax-free when you make significant gains. If you are considering making an account, just remember to read all the fine print and all the rules for opening such an account. For instance, the Roth IRA account has a 5-year rule, whereby you must not make any withdrawals before at least 5 years after your initial first contribution. In comparison, the IRA account is also a retirement account, but you must subtract contributions when you make them and pay taxes on them later, while the Roth IRA is inversed, where you pay taxes on your contributions initially, but you can withdraw your gains tax-free. Another popular investment account is the 401k, which, like the Roth IRA, allows you to grow your portfolio tax-free. The advantage that the 401k has over the Roth IRA is the fact that many companies and employers match your contributions up to a percentage of your amounted income. No matter what kind of investment account you open, just remember that having an account is better than not having one at all. Without a doubt, it is important that you do your own research on what kind of accounts you can have and how the accounts work, because each of them have their own system and their own tax benefits. Of course, with this being said, other countries have other accounts. They are not referred to as Roth IRA, IRA, or 401k. For example, in Canada, you can open a TFSA, which stands for Tax-Free Savings Account. In the UK, they have 4 different ISA accounts, which stands for Individual Savings Account. Number 3. You must understand your own risk and learn to manage it. One thing that many investors tend to ignore is making a plan and sticking with it. It is crucial to know what you are investing in, why you are investing in them, and how come you are investing in them. Professional investors know to leave their emotions out of their trades, and if you are new to investing, it would help tremendously if you create an investing plan and stick to it. If you see percentage gains in other companies that surpasses yours, think to yourself, look back to your investment plan, and ask yourself questions. If your initial thesis of investing into a company has not changed, then why change? Creating a plan and sticking to it also helps with 2 overwhelming traits that happen to almost every beginner investor. That is FOMOing and YOLOing. FOMO, or fear of missing out, will make you want to invest everything you have into a single company that has their gains flying through the stratosphere. YOLO, or you only live once will make you feel like you are not taking enough risk. And since you only live once, why not put everything you have into a company or two? These are very deadly things that can infect you. But just remember that things don't happen in a blink of an eye. Things come and go, and you cannot win them all. Number 4. You must learn what you are investing in. Many new investors choose ETFs to invest in, which is not a bad choice. An ETF is an exchange-traded fund, which is a security that tracks a sector, commodity, or asset, and can be bought and sold just like an individual stock. This means that an ETF can have a bundle or basket full of individual company stocks, because they all share the same theme of a common sector, such as the financial or technological sector. If you don't want to stay glued to the screen, an ETF might be the right choice for you. But even with that said, it is important that you know exactly what you are investing in and where your money goes. For instance, ETFs may be the right choice for you, but have you considered their management fees? What about the potential dividends? Management fees are what they sound like. An ETF takes a cut of your profits because they essentially manage the stocks within the ETF. Fees differ from ETF to ETF or from mutual fund to mutual fund, ranging anywhere around 0.25% to over 1%. Dividends are payments that companies give out to their shareholders to incentivize you to continue investing with them. Dividends can be paid out per month, quarterly, half a year, or annually, and it all depends on how the company wants to handle that. It is important to note that some companies don't give out dividends. Rather, they reinvest the money they would give to you back into the company for more potential growth. With that being said, there are definitely pros and cons to buying a stock simply because of the dividends they hand out. Even with all that in mind, the main thing that you really want to focus on is their future prospect and their fundamentals as a company. First, lay down the foundations, then build a castle, because without the proper foundations, a castle can never be built, and this is the same with investing in stocks. Number 5. Understand how your tax system works. Understanding how your country's tax system works is a must for investing. If you are fortunate enough to be able to have a tax-free account, this doesn't bar you from learning about taxes. First of all, whether your account is tax-free or not, learning about how taxes work in your country is an important step to financial literacy. Secondly, just because an account says tax-free doesn't always mean it's fully tax-free. As seen with the Roth IRA account, taxes must still be paid, and usually for certain accounts, there is a limit or threshold. If you overcontribute the amount you can put into your account, you most definitely will be penalized, potentially with tax payments. Therefore, with everything said, do yourself a favor and learn about taxes. After all, you shouldn't be afraid of doing taxes.